The stock market has fallen. Trade tensions are still apparent here. Weakness has eroded the real strength of the economy and only quantitative easing is left. So what's the solution? Well, printing even more money, of course. You came here for the truth, so let me unveil that for you. Today we're going to look at what has been happening in the stock market. I'm watching it live right now, and I will upload this video as soon as I'm done. Look at what is occurring with the Dow Jones Index. You can see that is down 350 points at the time of this recording. You'll see that this has been fluctuating throughout the day, but it is on a downward trend. Perhaps the plunge protection team will be out just before the stock market closes for today. I want to show you the Nasdaq, which is down 2.3% as of this moment here at 7,500 approximately. We're looking at Amazon stock down 3%. On the right hand side, you can see Netflix almost 6% down. Google's down 3%. Facebook down 3.5%. These stocks here are taking a nosedive, and this comes after a very, very long rise, a very, very strong rise that we have seen throughout 2018, while other stocks have been declining or remaining stagnant. People are taking their profits right now. This is a great opportunity to cash in, and they are seeing this as a way for them to basically take a little bit off the top, relax a bit, see how the market reacts. Now, why exactly is this occurring today? I'll cover that more in just a moment. Wanted to show you what's happening in China as well. As of the close of their market, it was down about 1% in this particular instance. Now, stocks kicked off the week trading lower on Monday as the administration reportedly prepares to restrict investments in U.S. technology by Chinese companies. So that is very significant. We are seeing that with the trade tensions escalating on both sides of the equation. This seems to be a big problem for the stock market in general. The Dow Jones dropped 405 points at one point, with Boeing and Intel among the biggest decliners in the index. The 30 stock index also fell below its 200-day moving average for the first time since May 3rd. This is a big indicator for the traders, for the algorithms out there. They watch this. As soon as it does hit that moving average, they tend to come in with the plunge protection team, support the markets, because this is something that ends up triggering a lot of these algorithms in the high frequency trading. So they're watching it. I can assure you that both the 50-day and the 200-day moving averages are very, very important, not to me, but the traders in general. So I definitely would suggest everybody take a very, very close look at the stock market today, see where it goes. Does it finish up at a reasonable level, or are we going to end up down? And how are they going to fix this? Because what I've been finding with the stock market is that they have been going up and down for this little period of time, when we've seen a lot of the stocks dropping, and then tech stocks have been there really to support this, the remainder of the market. But why? What has caused this? Well, it's been the trade tensions ever since. We started with the VIX index that had been obviously a big problem, and then we led into this whole mess with the trade, and nothing's been resolved. It's only gotten worse. So in that respect, shouldn't the stock market continue to decline every day, or shouldn't it just remain stagnant? Why does it go up by 400 points one day and go down by 400 points the next day? It's a whole scam that we're being, forced to look at here. The S&P 500 fell 1.7% as tech declined 2.5%, and it goes on. All right, now we're looking at that VIX index. I wanted to show you this because we constantly make the same mistakes over and over again. Nobody learns. What was really the catalyst right here leading into the late January that really brought this market down was VIX. Everybody was shorting the VIX, shorting volatility, knowing that this would simply decline further and further and further. There would be no volatility in sight. But instead, we had this quick turnaround, and it happened so rapidly, nobody expected it. And then we saw what happened. The VIX index shot up higher than it had been in years. Looking at this, In this particular instance here, this is the CFTC VIX futures net speculative positioning, and we've head back into that. So now all of a sudden, things had reversed. Okay, nobody wants to short the VIX anymore. Let's see where that goes. But that's been continuing now. Over these past few weeks, we've seen that trend reverse. And look, all throughout 2016 into 2017, it was all about short the VIX consistently. And more people were adding to that position. And then, when nobody expected it, we saw what occurred. We're just heading right back into that. What a joke. What a true joke. Nobody learns. No matter how hard they're hurt, they're not going to learn. Well, looking at the yield curve, it's just a matter of time before this inverts. Other yield curves have inverted as well, but this in particular, we need to focus on this here. This is always a leading indicator of recessions. And basically, I think it's every time but one occurrence. And we can see that we're headed in that territory. There's just no denying it. Many people would say, who cares, or this is not important, or so on. I look at it like it's one more indicator on top of the pile of hundreds that I've shown you here. Ultimately, it doesn't matter if the yield curve inverts, okay? But what I can tell historically is that when it does, we have a recession that follows. So how long is it going to be? How much is it going to take to get there? What's going to happen? All these questions. I don't know. But what I do know is that we can see that this is a leading indicator of a stock market crash, of a recession. And so I present it to you. You do what you want with it. Percentage of IPOs with negative earnings per share and fraction of tech stocks. Guess what? Once again, not only are we looking at necessarily percentage of tech stocks, I don't want to focus on that. I want to focus on this. Percentage of IPOs with earnings per share less than 0. And we are now back at the dot-com boom and bust. Okay? Everybody should be concerned about this, because when you have companies that don't make money, yet have these massive multi-billion-dollar valuations, when they can be bleeding out money and still more money is just pouring into them, something is unusual. You have all these so-called unicorn companies. They are valued at billions of dollars. They basically don't exist. Just a few months ago, they didn't exist. Now their valuation is billions of dollars. You know that a lot of hot money is flowing in. And we've seen historically, whenever hot money flows in from all directions into one particular thing, it ends up being a bubble. That bubble bursts very, very violently. Mergers and acquisitions activity, looking at this, going beyond the financial crisis, beyond the dot-com boom and bust. We are in a new territory today, seeing how ridiculous we have really become here, where these companies have been buying each other out in these huge deals, creating monopolies, creating less competition. And of course, the regulators say, oh yeah, no problem, you're allowed to do that. You can do this, it's safe, it's fine. It never is. And we find that out later down the road when it's too late. You can't split them up, or it's so difficult, it's almost impossible. And so we're left with more of the same. Now, this is a report out of the Biz. Now, the Biz is generally seen as the central bank of central banks. I don't necessarily like the Biz, but their reports, just like the IMF, do highlight the real problems, which is interesting. Their solutions are not good, but I like the way that they write up these reports. Seems like they have Dr. Jekyll and Mr. Hyde type of behavior here. The global economy developments, prospects, and risks. I'm not going to read you the whole thing. I just want to touch on a couple points here. It is now 10 years since the great financial crisis engulfed the world. At the time, following an unparalleled buildup of leverage among households and financial institutions, the world's financial system was on the brink of collapse. Thanks to the central banks, hallelujah, concerted efforts and their accommodative stance, printing a lot of damn money. A repeat of the Great Depression was avoided since then. Historically low, even negative interest rates, and unprecedentedly large central bank balance sheets have provided important support to the economy and have contributed to the gradual convergence of inflation towards objectives. Right. Basically, what they're saying is they've printed a lot of money. They've expanded their balance sheet so far that it's made up for all the real money that has left the system. So that's what you need to understand from this. And so they try to make it seem like the central banks have acted with such ingenuity, such intelligence, and they have done this in order to save the system. I have a difference of opinion, of course. But anyway, take a look at this and understand what the biz is trying to tell us. That the central banks are the savior, they are the lender of last resort, and they are there to protect people. However, what they're highlighting to me here is, and we got to read between the lines, is that the reason why the stock markets, the reason why I would say the global financial system has been so-called, I don't even want to say it myself, but let's say doing good, is simply because the central banks have intervened at a level they never ever have before in history. What do you think would happen if the central banks pulled out all of that stimulus? I'll leave that to you. If you found this video informative, please give me a thumbs up. When you give me a thumbs up, it helps to support this channel, so I do appreciate that very much. And if you want the financial education that was not taught to you in schools, that would make you one of the 99.999999% of people who go through their entire education and not learn a single thing about what to do with their money, how to protect their investments, where to invest, how to ask the right questions to your financial advisor, then these two books have it all. I've read countless books, been to seminars, watched countless seminars, listened to thousands and thousands of hours of audio books. I've spoken to people on the inside of the system, on the outside of the system. I've done my due diligence, and I squeezed all of that down into these two books. These two books basically fit into each other like puzzle pieces. They cover information that the other ones don't, although they do have some intertwining information. So definitely check those out. Link is in the description of this video. If you're more interested in the audiobook version, you can get that at themoneygps.com. If you're still here, just wanted to thank you very much for your time today in listening to this. I know that I say this a lot, but trust me when I say I am very, very grateful for you.